People often ask me what keeps me up at night when it comes to the markets. The truth is, not much does anymore. After 6 decades of watching markets gyrate, crash, soar, and crash again, I've learned that emotional responses to market movements are the surest path to poor returns. Facts matter. Reason matters. Panic and euphoria? Those are the enemies of wealth creation. Let me share something with you that I think captures the essence of successful investing. In baseball, there's a concept called called strikes, pitches you have to swing at or you're out. In investing, there are no called strikes. I can examine 1,000 companies without having to be right about every one, or 50, or even 25 of them. I can wait for the perfect pitch, and nobody's going to call me out for not swinging. Since I took control of my holding company back in 1965, we've averaged about 20% annual returns. That's roughly double what the S&P 500 has delivered over the same period. When you compound that difference over 60 years, it means the original investment has grown by approximately 5.5 million%, compared to about 39,000% for the broader market. I'm not sharing this to brag. I'm sharing it because those results came from following a set of principles that work in any market environment, including the one we're facing right now. The market environment we're navigating. As we transition from 2025 into 2026, we're seeing some concerning patterns that remind me of periods I've witnessed before. Artificial intelligence stocks are reaching valuations that would have seemed unimaginable just a few years ago. Take one of the major chip manufacturers. It's now worth more than all the major banks in the United States and Canada combined. Think about that for a moment. American debt, both private and public, is climbing exponentially. Some investors are starting to question the long-term stability of the dollar itself, particularly with the emergence of competing currency systems from China and the BRICS nations. And perhaps most concerning, the S&P 500 is more concentrated in a handful of stocks than at almost any point in history. It's perfectly rational for investors to feel stressed about what's coming. So let me walk you through 4 specific warning signs I'm watching in today's market, and then I'll share 4 principles that have guided me through every market cycle I've ever experienced. Warning sign number 1, the leverage problem. The first thing that concerns me deeply is the increasing amount of stock purchases being made with borrowed money. When you look at the data over the past 30 years, margin debt, that's money people borrow to buy stocks, has grown far faster than the actual market itself. What this tells us is that more and more of the current market valuation is built on a foundation of debt. I've explained before how this can lead to what I call a lost decade for equities. But beyond just stock purchases, we're seeing an economy where people are increasingly borrowing to maintain their lifestyle, partly due to high inflation and rising costs. Everything is simply more expensive. This situation troubles me because I've been warning about using debt to purchase securities for my entire career. Let me be crystal clear about this. Anything can happen in markets. That's why my advice has always been the same. Never borrow money against your securities. Never. The great fear here is that debt is being used to artificially inflate prices beyond what they should be. There's more money in the market than should be there based on underlying economic fundamentals. This contributes to stocks reaching unsustainable valuations and increases the volatility we're experiencing. You can see this in the VIX index, which tracks expected volatility in the S&P 500. In just the last month, it's jumped over 30%. That's a clear signal that investors are not expecting market conditions to calm down anytime soon. But before we look at the other 3 warning signs, let me share my first rule for navigating this environment. Principle 1. Buy businesses, not stocks. I look at the business, not at the stock price. This is fundamental. Only someone who truly understands the underlying business can invest successfully over the long term. Whenever we see markets rise to inappropriate prices, it follows the same pattern. Investors buy a stock intending to sell it to someone else at a higher price. They don't care what the underlying business is fundamentally worth. They're just looking for a quick profit. When you haven't studied the fundamental business, it becomes very difficult to determine whether a stock is overvalued or not. You're essentially flying blind, making decisions based on price momentum rather than intrinsic value. So what do we take from this advice? If the market is overvalued and we see a decline in stock prices, certain types of businesses tend to perform well regardless of what the broader economy is doing. Companies that provide essential goods and services, pharmaceuticals, food, telecommunications, these are called defensive stocks. As a group, they often significantly outperform when the broader market declines because they operate in industries where people are reluctant to cut spending. Now, this applies to the sector as a whole. Individual stocks can still rise or fall based on their specific business performance. Let me share an analogy that my longtime mentor taught me, one that I found incredibly useful over the decades. It helps to think about stocks as if you owned a business with a partner I'll call Mr. Market. Imagine you have a small stake in this business worth $1,000. Mr. Market is very accommodating, but he's also a bit manic depressive. Every few days he tells you what he thinks your small business is worth and offers either to buy you out or sell you more shares. Sometimes his offer seems reasonable based on how the business is actually performing, but other times enthusiasm or fear gets the better of Mr. Market and he offers you absurd prices, sometimes way too high, sometimes way too low. Mr. Market is like the stock market itself, and we are like the business owner. We get to decide whether we think Mr. Market is asking too much or offering shares at a discount. And we can be selective, choosing only those businesses being offered at prices we consider fair. But how do we determine if a price is fair? That brings us to the second warning sign and my second investing principle. Warning sign number 2, dangerous concentration. Beyond the high leverage in the market, we're seeing a second risk contributing to overvaluation: concentration risk. Here's the official definition. When your portfolio is too focused on one type of investment, you can lose significant money if that investment declines in value. It's like a school project where only a few people do all the work, and if those few people stop working, the entire project can fail. That's essentially what's happening in the S&P 500 right now. A massive portion of recent growth in the index has been carried by just a handful of giant technology companies. According to Goldman Sachs, the 10 largest companies in the S&P 500 now account for about a third of the entire index value. That's even more concentrated than during the dot-com bubble in 2000. If these few companies run into problems, they could drag down the entire S&P 500, even if the other 490 companies are doing fine. This is also why the price-to-earnings ratio of the S&P 500, which measures average stock prices relative to average corporate earnings, is now above 30. The last time it was this high was before the market correction in 2021, and before that in 2008. Historically, the S&P 500's P/E ratio sits between 16 and 20. To get back to those levels at today's prices would require about a 50% decline. Much of this is being driven by AI and technology companies. Don't misunderstand me. I'm not saying AI doesn't create value. It certainly does. I personally have significant investments in several technology stocks. But I think my second principle really illustrates the difference between investing and speculating. Principle 2. Stay within your circle of competence. Let me share an analogy I often use when a new technology starts gaining momentum in the market. I used to give presentations where I'd bring along a 70-page, densely printed list showing 2,000 automobile companies that existed in the early 20th century. If you had seen at the beginning of the 1900s what the automobile would do for this country, the impact it would have, you'd have been right to be excited. But of those 2,000 companies, essentially only 3 survived as major players. So how do you pick the 3 winners from 2000? It's not that simple. Every new transformative technology is like the automobile in 1905. You might recognize that a technology will change the world just like the car did, but you need a different level of expertise to understand which company will ultimately win in that new technological landscape. My solution to this is quite straightforward. Clearly defining your circle of competence is the critical aspect of investing. You don't need to be an expert in everything. But knowing where the edge of that circle is, what you know and what you don't know, and staying within it is paramount. Invest exclusively within your circle of competence, meaning in those market segments you know best and truly understand. If you ask me to repair a boat, I know nothing about that. I grew up in the mountains. I'd be more helpful with your cloud computing question. Ask a boat mechanic? They'll beat me on engines every time, but they probably can't fix a network. And it's the same with investing. You don't have to be an expert in everything, and you don't have to invest in every trend. Before buying a stock, ask yourself, am I really an expert in this field? Do I know how AI works, how companies use it, and how it creates value? If yes, you can probably find bargains in the stock market. If not, you'll easily get swept up with the crowd that's buying whatever is currently popular. And that's a very important lesson I've had to learn repeatedly over the years. Warning sign number 3, the Buffett indicator. Even if you stick to industries within your circle of competence and view companies as businesses, you can still get hurt by a generally falling market. So let's look at the third warning sign, and this one is very specific to how I evaluate overall market valuations. Back in 1998, I issued a famous warning that the United States was headed for a lost decade in stocks, where the market would achieve no meaningful returns in the first 10 years of the 2000s. That forecast was absolutely correct. From 2000 to 2012, the market delivered annual returns of only about 2%, which was less than inflation. This happened because the dot-com bubble burst, and it took years for the market to recover. In the following years, it seemed almost miraculous that I had made this prediction while the rest of the market was so wrong. But in 2001, I revealed an indicator, essentially a single number that investors could look at to determine whether the market was overvalued or not. I called it probably the best single measure of where valuations stand at any given moment. Though I later walked that quote back somewhat, it became known as an indicator bearing my name. It looks at a very simple relationship and can serve as a data point for how expensive the market currently is. It may seem mathematical, but the core idea is quite simple. Take the total value of all U.S. stocks and divide it by the total U.S. economic output, the GDP. Basically, it shows how much people are paying for companies compared to the real economic production. It's a very illustrative indicator that goes beyond pure spreadsheets. And while this isn't the be-all and end-all that tells us exactly when a market will crash, it's still a useful data point that gives us a sense of where we stand. And right now, this indicator is flashing a warning light. Looking at the historical chart of this metric over time, there's a trend line representing the average growth we've seen historically. In 2020, the market crossed one standard deviation above this line, and today we're more than 2 standard deviations above it. This means the market is now 69% above the historical expected value. Since we've never maintained this level of deviation for longer than 6 months without experiencing a market correction, it's a useful data point for understanding how expensive the market currently is. So how should we respond to this? This brings us to my third principle. Principle 3, the margin of safety. Good companies alone are often not enough because strong downturns usually pull down almost all stocks in the major indices simultaneously. Even a truly great business can fall in value during a market-wide correction. Obviously, you'd need only a very small margin of safety if you could understand a business and its future perfectly. The more volatile the business or its prospects, the larger the margin of safety must be. A margin of safety is essentially a buffer between the value of something and the price we pay. Let me give you an analogy for how we should scale this margin of safety depending on what we're investing in. If you're driving a truck across a bridge that's rated to hold 10,000 pounds and you have a vehicle weighing 9,800 pounds, you might feel okay if the bridge is only 6 inches above the ground. But if it's spanning the Grand Canyon, you'll probably want a somewhat larger margin of safety. It's the same with buying stocks in this market. If you're buying a defensive stock like a utility company, you might need a smaller margin of safety than if you're buying a high-risk stock such as a hot AI company. A utility stock is like driving a truck over a low bridge, While certain AI stocks can be like driving across a bridge over the Grand Canyon, the consequences of failure are simply much more severe. But I think this advice also applies to today's market in general. Because if we experience a market crash, the probability of us timing it correctly, selling before the crash and buying back in later, is very low. It sounds simple, but in practice it just doesn't work consistently. 3 studies in finance have proven this. Holding through a downturn far outperforms constant trading. So if we must plan to weather a market downturn, then we need to build a margin of safety into our portfolios so we can survive the many temporary downturns that someone like myself has experienced throughout their career. This allows us to survive as long-term investors and benefit from the compound interest effect of the market over time. Warning sign number 4, retail speculation. This next warning sign is actually much more specific to retail investors, which is basically Wall Street's name for regular investors who buy stocks. Essentially, that's you and me participating in the market. A recent chart shows retail investor interest in riskier forms of trading, day trading, options, swing trading. We've recently seen a sharp increase, coinciding with an equally sharp increase in cash sitting on the sidelines of the market. Basically, available income that people could put into stocks. Historically, we see this type of activity before a market correction because it's an indicator that people are viewing the market as a short-term game rather than holding as long-term investors. Those who know exactly what they're doing can certainly use tools like options meaningfully at any time. And while 90% of traders lose money, there are some who succeed. That brings us to my 4th and final principle. Principle 4, the 20 punch card. I like to use analogies, and this one has stuck with people over the years. I often tell students they should get a punch card with only 20 holes. Then they wouldn't buy stocks impulsively after a cocktail party, but would think carefully about each hole. 20 holes are completely sufficient. The idea is if you could only buy 20 stocks in your entire life, and when those are used up, that's it, you can't buy any more. Well, we'd be much more careful about selecting the stocks we purchase. And this rule of minimizing activity is a lesson that applies today just as much as it did then. As I wrote in my shareholder letter back in 1983, a hyperactive stock market is the pickpocket of enterprise value. There's a famous story about a study at one of the major investment firms. As far as I know, it's apocryphal, but the lesson from it is still very useful. The story goes that they wanted to find out which type of investor performed best in the stock market. They looked at all the accounts across the entire company and found that the second best investors were those who had forgotten they had accounts with the firm. But the best performing investors were the dead ones. Sometimes it's not about doing more, it's about making one good investment decision and then simply forgetting about it for a very, very long time. Final thoughts. Navigating uncertainty. As we look ahead into 2026 and beyond, I want to leave you with this thought. Markets will always have periods of exuberance and periods of despair. That's not a bug, it's a feature. The key is to maintain your rationality when everyone around you is losing theirs. The 4 warning signs I've outlined, excessive leverage, dangerous concentration, elevated valuations based on historical metrics, and increased retail speculation, these are all flashing yellow, if not red. But that doesn't mean you should panic. It means you should be thoughtful. Apply the 4 principles. Buy businesses, not stocks. Stay within your circle of competence. Maintain a margin of safety, and be selective with your investments. If you do these things, you'll not only survive the inevitable market corrections, you'll thrive in their aftermath. Remember, investing is not about predicting the future with perfect accuracy. It's about positioning yourself so that you can profit regardless of what the future brings. It's about being greedy when others are fearful, and fearful when others are greedy. The beautiful thing about sound investment principles is that they work in any market environment. They worked in 1965 when I started this journey. They worked through the crashes and booms of the decades since, and they'll work in 2026 and beyond. Stay rational, stay patient, and most importantly, stay focused on the long term. That's where real wealth is built.